This is the Daily Market Rundown live from the Tradelo trading floor. It's September the 5th. Some highlights from today's show. Stocks hit a record before NFP. VIX is transitioning to a new regime, and the NFP data is now in focus. Good day, traders. Happy Friday. Welcome. It's non-farm payrolls. We know what to expect going forward. Now, let's get stuck straight into it. There's a number of things to talk about. And I think there's some key things to point out, of course, as we get into the non-farms, and some things to pay very close attention to. First thing, of course, just a bit of an overnight recap. We did have a tweet or a truth, or whatever you want to call it, from President Trump out overnight, just talking about how we are going to see the impact of his policies only coming through at some point in the future. And again, I think there's been a little bit of a hint or a slant taken from this, from the markets, that there's perhaps a bit of a softer than expected print coming in today. And so I think that's the general lean, and I think that matters because I think some of the hedging that might have gone into the markets Monday, Tuesday, Wednesday as we got back from the summer break, that's now all come out of the market. There is very little in the way of implied hedging going into this number. Now that matters. I think it matters a crucial amount, and we'll talk about that when we get to the VIX. But what it does is it sets up a scenario where perhaps the expectations are leaning on this idea of we're going to get a number more or less around the median expectation. Okay, so within 20 to 30,000 of what's expected. So if the expected number is 75k, think the market is now expecting somewhere between 45 and of course 100. Okay, the point is if that's what the market's sort of thinking we're going to get, and that's the way it's pricing it, ultimately we need to be prepared for what comes if we got, let's say, a negative number, or of course if we got a blowout number like 200,000. And we'll talk about that in a moment. But the key takeaway is equities rallied off of this tweet. Okay, so we've seen that most of the stock markets in the US move towards a record high territory. It started in the late session yesterday. It followed through in Europe today. Okay, we also saw at the same time a bit of dollar weakness. We also saw gold go bad. We saw the bonds go bad. Okay, the point is in general, the thinking was we're going to get a slight miss perhaps on expectations, or somewhat of a soft number. Not a weak number, not a recessionary number, a soft number. What I mean by soft number? Well, it's a little bit less than expected, and that's why the equities have gone bid. Okay, if it was a lot more than expected, equities wouldn't have gone bid. But again, we'll talk about that when we get to scenarios in a moment. Now, some of the key things to pay attention to, and we'll start this as our rundown in essence. We know that Steve Englander, this came out in the Bloomberg, I think 2 days ago, he was talking about this idea of a number below 40,000 or an unemployment above 4.4 as being sort of almost a threshold point where the door is open to 50 basis points cut in September. Okay, I want to stress, do not rule this out as a scenario. The Fed has still got policy sufficiently restrictive. They think it's restrictive. They've told us it's restrictive, and they've told us they do want to begin the process of cutting rates in the near term. Okay. Now, should we get a very bad number today? Should we get a number that's negative or an unemployment rate at 4.4%? The reality is the Fed is not going to hang around. They changed the strategy and the playbook last year when Powell came out and cut 50 basis points after the Jackson Hole in August. Okay, he did this because there was a significant revision to the number of jobs that had been created. They frightened ultimately as a result. They thought perhaps they were very far behind the curve because, of course, policy rates were significantly higher at this time last year. Okay, so the point was the Fed wasn't going to hang around guessing. Their new policy was very restrictive, and they knew they had a lot of cuts to get to neutral, and that's why they kicked off with 50 basis points. It's the same today. Okay, if the Fed thinks neutral's 150 basis points lower, if we get a negative number today, they're not going to hang around. They're going to take out insurance. They're going to cut 50, and that's the way the market's going to trade. It's along the front end of the curve. It's short the dollar. It's long gold. It's short equities, and we'll talk about that scenario in a moment. Okay. So I think just pay attention. Those are two key numbers. Less than 40,000, above 4.4. I think that is somewhere, and I'll map this out for you in a drawing in a minute, but keep that in the back of your mind. Okay. The general idea is that the Fed has told us that somewhere around 70,000 jobs a month is what they think we need to keep the unemployment rate steady. Okay, that's the general consensus, the thinking from the Fed. It used to be 100,000, and Powell and co. has now revised that somewhat lower because of the change in immigration policy. Okay, so 70,000 net to net is a good number. It's a good number that reflects a labor market that's good. Not great, not weak, good. So the inline number, it's important to stress this. We get an inline number today. That's a good labor market, and the Fed is still going to cut. Good labor market, Fed going to cut. equities go to record high. It's as simple as that. Okay, and we'll talk about some of those scenarios when we talk about JP Morgan, because there's something, in fact, let's get to it. If you go and read through this and you look at it, what JP Morgan is in essence telling us is there's a 95% chance equities go up today and a 5% chance going down. Do you now understand perhaps why equities have rallied the last 3 sessions and rallied into non-farms and rallied again overnight? Well, if there's a 95% chance that stocks go up in all scenarios, the reality is that everyone seems to think the same thing. Okay, in which there's very little that can derail the equities. So why not go long before the number? Okay, but that matters. And I'll stress this because if you go back to 2024, and I'll show you this on the chart, there was a moment in March 2024 where the market was very relaxed, almost identical today. They were over-relaxed. And we got a bit of a shock print. We got a massive beat. I think it was 250,000 on the headline NFP print. And the market was pricing in 7 rate cuts in the next 6 meetings. And all of a sudden, the market had to reprice those rate cut expectations. Okay? The point is that should we get a big beat today? Should we get a number in excess of 200,000? All bets are off. That September cut gets challenged. It gets pulled out of the market. Dollar flies up the page. Equities have a nosebleed moment. And of course, VIX will need to move its way back higher. Okay, so it's important you start to understand where these key moments are for today, because that's what our job is as traders. We've got to prepare for what if it comes out at 200K? What do we prepare for if it comes out above 100? What's a good number? What's a bad number? Okay, that is our job. Now, in terms of historical weakness, just note that the last 10 out of the 15 years, August has missed. Okay, so again, there's a little bit of seasonality involved in that, but 10 out of 15 is what, 67% chance. So take it with a pinch of salt. Okay, what I would say that's probably contextually true and important, the last 3 prints in a row have been very, very weak in the US. Okay, so if you're going to go on trend, ultimately the trend doesn't exactly point to a blowout number coming today. If anything, it's an inline number or slightly weakness. Okay, or of course the negative print. Do not rule out a negative print. What I can tell you, if you go and study some of the case studies around the 2008 financial crisis, non-farm payrolls were coming out wonderfully every single month, and then all of a sudden they printed horribly and we got some significant downside revisions. Okay, so pay attention to downside revisions because typically what they're indicating is that things are perhaps a lot softer than what everyone's been expecting. Okay, don't forget, of course, what we see month over month is like a first guess. They then have a second guess, and then a year later they have like a third guess. Okay, the point is that these things get revised all the time, and we know that the prints at face value, the prints we've been receiving in the last 3 months are weak. Okay, so if we start to get even bigger revisions, what it's telling us is that the Fed has overcooked things. They've stayed restrictive for far too long. And again, the Fed is currently 150 basis points restrictive. In other words, they can cut 150 basis points before they get you neutral. So if we got a negative print, they're not going to stop at neutral. They need to support the market. So they need to cut more than 150 basis points. Okay, that's how you have to think about it. Negative print today, you got cuts coming, you got 150 basis point cuts probably coming over the next 3 meetings. All right, that's how you have to think about it, and that's the real golden trade today. If we get that, we get a negative print, all bets are off. You've got to be going all in. You've got to be looking to short that dollar long gold, short equities, and then go and have a good party on the weekend. In terms of then the expectations, 75 is the median. The range of expectations on Bloomberg is 0 up to 144. So it's 0 to 144 is the range of expectations. I think in terms of, and again, I'm going to scale this out so we can, in fact, let's do this somewhere we got a little bit more space. Okay, if we're going to talk about a range of expectations, okay, I think the way to plot this is on the downside, you can have 40,000. On the upside, I think you can have, call it 140,000. Okay, or 144. I think anywhere within that range, anywhere from 40 to 144 is positive. Net, it points to a labor market that's on the downside, okay, on the upside, good, solid. Okay, so within that range of 40 to 144, there really isn't a lot to worry about. The closer you get to that downside, I mean, September is definitely a guaranteed cut, but the closer you get to the downside, the more likely it is we get a third cut this year. So at every other meeting, at every meeting rather than every other meeting. So the closer you get to that 40K, again, it's going to be taken as dovish, but not problematic. Right? The way you have to see this is very simple. If the economy is okay, that's positive for equities. If the economy is in a recession, that's a problem for the equities. If the economy is stupidly hot, that's a problem for the equities. Okay, so a number between 40 and 144 is a good labor market. It's an okay labor market, and it points to GDP around 1.5% to 2%. That's an okay scenario, and at a time when the Fed can cut. That's a good scenario to be in for the equities. Okay, so I think that's your range, 40 to 144. I think anywhere within there, I think equities are really difficult to sell, and I think selling it, particularly now that we're breaking out to record highs, doesn't make any sense. Okay, VIX is squashing, and I suspect you get a number between there. VIX will continue to squash. If VIX continues to squash today, the reality of the situation is that equities are going to open up to the upside. Okay, it becomes like a CTA paradise. They just love the momentum of it. There's like no risk, so why not join the parade? Okay, don't forget, everybody wants a pullback. Every single person on Wall Street that has missed this rally of 34% in the S&P 500 wants a pullback. They're desperate for it. Okay, that's why everyone is talking about September being seasonally weak. All right, the point is, if we don't get that seasonality weakness, everyone's going to be forced to buy the high tick. And if everyone's forced to buy the high tick plus the CTAs, where are we going? We're not going down. We're going up. Okay, so just make sure you're aware of that. Now on the flip side, let's change the color so we talk about scenarios. I think on the other side of the equation, sub 40 is problematic. Of course, I'm going to write there 4.4% unemployment because that also matters. Don't forget the Fed is forecasting 4.5% unemployment for the end of this year. 4.4 for the end of this year, 4.5 for next year. So if we get to 4.4 already now, what it calls into question is ultimately, are their forecasts wrong for next year and the year beyond? Okay, so that's why 4.4 is also problematic. Now, sub 40, again, that's going to prove to be a bit of a problem. It's a straightforward trade, however. Okay, you've got to play a rates trade. You've got to be playing in the front end of the US curve. You've got to be expecting that that's going to move 30 to 35 basis points today, plus perhaps another 10 or so on Monday. Why? Well, because it opens the door to 50 basis points, of course, for September. But as well, we are likely to get at least 3 cuts this year, but probably more. Okay, so the point is that front end of the rates curve, that's where you aim below 40,000. Also the dollar. Okay, we'll talk about that dollar chart in a moment. It's done squat diddly do for 4 weeks. And in particular the euro. Okay, the euro is the strongest performing currency against the dollar. Pay attention there. That's where you want to be trading should we get a sub 40,000. And then of course the likes of gold, that will always do well in a risk off scenario. A weak number, it's not exactly going to be a risk on type day. In terms of equities, again, I think a sub 40, it depends. If it's like 38, yeah, okay, there's going to be quite a bit of chop. There's going to be quite a bit of movement. And I think what it comes down to, and this is the big question mark, is what does the VIX do? Okay, if the VIX does not start to rise on the back of that, it suggests that it's okay. The market can accept it as it's not the end of the world, and it's not going to challenge growth expectations. The problem comes is if the VIX starts to rise, if we get above 16 and 16.5 and 17, we start to get back to those levels. What it suggests is that perhaps growth expectations are a bit lofty for this year, next year, and perhaps the odds of a recession should be revised a little bit higher. In that scenario, equity is not going to hold up well. We know everyone wants that pullback. We know there's a lot of people long. We know that ultimately we did see a little bit of weakness in the equities at the start of this month. The point is, I think people will jump on that trade sub 40. Okay, but like I said, keep an eye on that VIX as a proxy. On the upside, above 144, what does that do? Well, look, above 144, again, it depends on the degree. Let's go a little bit crazy and talk about 200,000. You get a 200,000 print today and a 4.2 unemployment. Well, good luck, Mr. Fed, trying to communicate a rate cut in September. Okay, it will call into question their credibility because everyone will turn around and say, well, they're cutting because the president told them to do so. Okay, so I think the play from that standpoint is ultimately we get a plus 200,000. I think the bonds will scare, particularly the back end bonds. They will scare because of that idea which I told you. The front end won't get rid of a rate cut on a 200,000 print. They'll probably reduce it to around 50%, but they're not going to get rid of it. Okay, why? Well, because Chairman Powell opened up the door to a cut in September. So 200,000 won't impact the front end, but it will impact the back end because the logic is, well, they might still cut. Things are strengthening. They ultimately adding more fuel to the fire. That's going to keep things very hot. So the back end of the curve should shake out a little bit. Okay. On that note as well, a really, really strong number. Again, I think it depends ultimately on how the bonds respond. If they shank and they offer and you see the 30-year down 20, 25 basis points, that will pull the equities lower as well. Okay, so just keep an eye on that. It's a lot of ifs and buts. The key takeaway is watch the proxy markets. On a weak number, watch ultimately what the VIX does. On a very big beat, watch what the bonds do. They will dictate what risk does ultimately. That's how you play it. It's very much watching those two proxy markets, and then ultimately that will give you the answers to how the market's interpreting it. Okay. Now, in terms of, I'm not going to go through this. You can read through this. This is available in the Discord channel. If you go to the Tradelo Squawk channel, you can actually go and read this full rundown for you. It will be very informative. And of course, that is posted for all the non-farm prints. Now, In terms of some of the markets, this is what I mentioned. We are in a bit of a regime change. Okay, you can see this blue line, that is ultimately the 50-day average of the VIX. And again, what I want to sort of draw your attention to is not necessarily where VIX is today, but where VIX was ultimately in 2024. Okay, 2024 was this whole idea of soft landing. It was the general theme for 2024. Nothing can go wrong. And if you go and have a look at equity performance in 2024, we had a 30% year. Okay, why was that? Well, because the VIX was trading around 13 on average for most of the year. And sure, it had a little bit of a move in April. That was, like I said, when we got the very hot data where the market had to price out almost all of the cuts that were in the market. That's this point here. And that was it. It was that non-farm payrolls where we got a really big beat. The market priced out the cuts. The VIX spiked. But ultimately, what did it do? It said, yeah, things aren't so bad. And we literally sat in an average 13 VIX for the entire year. What did the stock market do? 30% up. Where's the S&P 500 in terms of current year to date? 9%. Could we have another 30% year? Absolutely yes. Okay, that VIX squashes back down to 13s. All bets are off. You do not want to be selling this risk market. Like I said, people are underinvested in this rally. Why? Because they haven't been allowed into it. That's the key takeaway. In terms of levels to the upside, I definitely think keep an eye on that 19. Like I said, negative print, we're probably going to test there. We extend that. We're probably going to keep extending it over the next couple of days. Why? Because the recession has to be priced. Okay. Now, in terms of the data, there it is. I'm going to just show it to you back in 2024. It was this month over. Where is it? It was somewhere around. I think it was somewhere around that month. We had a really, really big beat in the non-farm payrolls. I think it was somewhere over there. And ultimately, market staged a fright on that. Now, what I want to point attention to is in terms of the last six sort of prints of non-farm payrolls, note how sort of month to month stable they've been. Okay, so we've not seen dramatic movements in the month over month non-farm payroll prints. Okay, but look at the purple line. That's a 3-month average. It's very clearly not going up. It's very clearly not going sideways. Look at 2024. What did it do? Well, for most of the year, it went sideways, started moving down. What did the Fed do? Cut 50. Okay, they were a little bit wrong ultimately, and things started to reaccelerate. Things weren't as bad as expected. Okay, what are we seeing now? Again, slow down, contextually slow down. Weak print today, 50 basis points definitely opens up. Okay, do not underestimate the Fed. They will cut 50 without thinking twice. In terms of the unemployment rate, expected is 4.3. Like I said, a 4.3 will be a cycle high. Okay, we've not been there since 2021 COVID era. So 4.3 does again concern, but I think what matters more today, again, notice the month over months, it's never really been more than 0.1. We did have one exception, which was that point in 2024 where the unemployment rate ticked up by 0.2. So keep an eye on that. And like I said, if you get a 4.4 today, that is going to be very problematic for the Fed. Ultimately, they're going to have to move 50 very quick. But if we keep it in line with 4.2 again, really does point to a situation where you have a very solid labor market. Okay. And then in terms of the ZT, I cannot stress 350 to be important. It's a significant level. Why? Well, because it seems to be the point the market has not been able to break below. Why? Because every time the market gets there, what happens? All of a sudden things reaccelerate, and gets there, reaccelerate. The point is that the economy has shown signs of weakness, but ultimately the 2-year yields have never really actually broken down. Why? Because we haven't really actually had that very aggressive rate cut cycle. And don't forget, the Fed only cut 100 basis points last year. So the point is that until such a time that we get a real clear signal that the Fed's going to get their skates on and get to neutral, we're going to stay range bound, right? 3.5% below that is positive for equities, obviously depending what's creating that shift. If all of a sudden we get a negative print today, you can bet your bottom dollar we're below 3.5. That's not positive for equities. If we get a number at say 50K, ultimately I expect that 2-year yield to start to move down towards that 3% in the next couple of days. And that is very, very positive for equities. Okay, context matters. In terms of then the Dixie, like I said, it's a market that wants to do something. It wants to go somewhere. The weekly chart is begging us to do something, and something we might get today. Negative print, don't be surprised to see those June lows tested very quickly. Like I said, Euro is the focal point. After that, Swiss franc. That's where you take aim. That's where you'll get best bang for buck. But don't forget, everybody is short a dollar. You get a number print above 200 or 1,000. Guess what? Those shorts are going to come unstuck. It is a consensus trade, and it will be fast money. You'll get some really decent moves. And in terms of weakness, where do you take aim? Well, we do know that the pound has shown some wobbles this week. So keep an eye on the pound. I think that's one that could be attacked to the downside quite nicely should we see a very good print in terms of the non-farm payrolls. And then finally, the equities. Well, what's not to love about them? All you really need to know is that, of course, you can see the right over there. You can see the S&P 500 made that record high yesterday. Nasdaq a little bit behind, but almost back at record highs. And then finally, the Russell has been the underperformer of the year. However, note, since Jackson Hole, since this vertical line, of course, Russell is the massive outperformer. Why? Because, of course, those rate cuts are incoming. Now, very important for today, where do you take aim? Well, if ultimately we get a more or less inline number, okay, that is just going to keep being positive for Russell. Russell's getting very close to those record highs as well. I'll show you that chart in a minute. So Russell is the place to take aim. Again, if you're going to get a negative print, you don't want to be touching Russell. You don't want to be touching any of the equities for that matter, because they should all come under some pressure. If you get a very, very solid print, again, I think the equities will still perform well. So if you get a sort of 100, 110 plus, equities will still perform okay, but perhaps you get a little bit more rotation. Okay, so perhaps you get a bit more rotation out of tech into Russell. In that case, buy the dip in the Russell and ultimately sell the rallies in S&P and Nasdaq. Okay, but again, watch the VIX. The VIX will tell you exactly what the equities are going to do. And then there is the Russell chart. As you can see, it can do no wrong on a weekly chart. It's a 5-sequence, one-time framing. Again, just clear blue skies. Nothing stops us ultimately up the sort of 65 level. I suspect we test that today, particularly if we come within that range. Like I said, 44 to 144. Remember that range, somewhere in there. I suspect Russell's going to be testing up there over the course of next week. Okay, that's then a wrap for today. Look, there's a lot to take on. There's a lot to take in. It's a volatile session. It should be a wonderful session. Just make sure you plot out those scenarios. That's how you do this thing. It's just plot out the scenarios, take the risk, execute it, and then move forward on to the next tradable opportunity. If there are any other questions, of course, do post them in the Discord channel. And like always, go manage that risk. Good luck out there. Go make some money.